Homeowners in the United States worry that rising mortgage rates will scare away. Sellers admit one of the most unpredictable reversals since 2008. Out of fear, real estate analysts worry that prices will overshoot downward after the predicted double-digit decrease in home values early next year. After watching their equity decline by almost $1.5 trillion this year, homeowners should be prepared for a bad 2023. In the video we're releasing today, we'll reveal that. Before proceeding, please remember to subscribe and show your support by giving this video a thumbs up. After the health crisis, artificially low interest rates are letting air out of the housing bubble that the Fed constructed. Data provided by the Dallas Fed shows the home values increased by roughly 95% between the first quarter of 2013 and the second quarter of 2022. As a result of the historically low interest rates that have made mortgages more accessible during the past 10 years. A significant portion of the growth, roughly 50%, took place between 2020 and 2022. As a result of the rise of the work-from-home trend, easy access to credit and fiscal stimulus, in March 2020 the median price of an existing home was $287,000. The National Association of Realtors estimates that by June 2022 some would have increased to $413,800, a staggering 47% increase in just 2 years. Eric Lund, the chief economist for the Conference Board, says that this big increase was even bigger than the rise in home prices during the last bubble. It's true that American homeowners need to get ready for a dreary 2023 between January 2020 and June 2022. US home prices went up by an amazing 45%. This was because low mortgage rates and more people working from home boosted demand after years of low investment and limited supply. For instance, prices rose by 30% during a comparable period in the years before the housing slump that began 16 years ago. The expert said the fact that mortgage purchase applications are down 41% from a year ago, and are actually lower now than they were at the height of the 2008 financial crisis, however, shows that the demand surge, the support of the expansion of the present bubble, hasn't only pretty much died out, but is turning around. All of this is due to the highest mortgage rates in 20 years. Enrique Martinique Garcia, a Dallas Fed economist, conducted research Highland fighting the unsettling impact. He thought that home prices could fall by 20%, which would have effects on inflation, economic growth, and the economy's long-term health in the current environment. According to Adam Slater, senior economist and consulting firm Oxford Economics for Red Firm's CEO Glenn Kelman, markets have been poised between the possibility of mild declines and considerably greater decline since 2007 to 2008. 1% Redfin's chief economist Chen Chow claimed in a statement that the Fed's efforts to control inflation are forcing the housing market to contract at a rate not seen since the financial crisis. Wolf Richter, an economist and financial analyst, says that the drop in sales shows that both buyers and sellers may be having trouble. Many people who want to sell won't change their asking price to reflect reality, because they think things will get better and hope or pray that the Fed will do a miracle. As a result, they either choose not to list their home or remove it from the market after receiving no interest at their aspirational asking price. But buyers have lost interest at the current prices. Ian Shepherdson, an economist at Pantheon Microeconomics, who recently told clients that the U.S. housing market is about to hit bottom, says that the trend has already changed and that demand is likely to level off in the coming months. As falling demand affects the market, property prices likely to go up in the coming months. The economist warns that prices must go down a lot before they can go back to where they should be. In a study published in late October, Shepherdson noted that the median price of all types of homes fell for the fourth consecutive month last month, and is now 8% lower than its peak in June. According to the official data, the 8% decline was the biggest for its fourth month since the previous recession. If mortgage lending fails once more, Richter predicts on his blog Wolf Street, there will be a huge wave of foreclosures that will largely target taxes Rather than banks simply put, if mortgage defaults and foreclosures increase once more, it will be our money on the line and to a lesser extent that of investors. We have all the ingredients for a perfect storm in place: rising unemployment rates and declining consumer spending, and all we can do is watch this slow-motion train accident happening in front of our very eyes. Thank you for watching. Please leave comments below the video, don't forget to subscribe, and we'll talk to you soon.